Hey, what's going on everyone? It's Griffin here, and I hope you're all having a great day as always. Now, in today's video, I wanted to speak about a couple elements and factors that are contributing to the market environment that we're living in right now, along with really what I'm doing in my own portfolio and with my investments as a whole. Because I made this video right here about a week or so back now, speaking about the state of the stock market, but more from an investor behavior standpoint and what I've sort of been noticing, especially with newer investors, how they're approaching their investments and individual positions during this time in the market where certain industries have been seeing some stagnation or even some quite hefty pullbacks following this period of quite rich valuations. Obviously, I won't recap everything we spoke about in that video. Make sure to check it out if you haven't already, but the main gist of it had to do with how to properly approach your portfolio and your investments during different market cycles in the equity markets more specifically, right? It's completely normal to see market cycles throughout the course of your investing career, and you're undoubtedly going to see many more. With that said, let's just get right into it. So over the past couple of months, I have mentioned in multiple videos that the American stock market, while hands down one of the best places to have invested your money historically and also over the past couple of years, what we're seeing an excessive amount of capital being poured into the American stock market over the past year and a half really as a result of stimulus along with rock bottom interest rates. This shouldn't really be any new information to you if you've been following my content for a while, but what this has led to are quite rich valuations from an average price to earnings standpoint. So this chart right here clearly showcases this reality for the S&P 500, which is composed of large cap American stocks, mainly dominated by tech in the top 10 positions, which have been relentlessly climbing over the past year. And the same phenomenon has also been apparent in other large indexes that hold mainly large cap American tech stocks specifically. For example, the NASDAQ 100, where a year ago the trailing 12-month PE ratio was sitting at 27.85. And it's now currently sitting at around 35.86, and this is already considering the recent performance of companies like Apple and Amazon. So even though most of these top American tech stocks have absolutely crushed earnings expectations and posted fantastic revenue and other financial figures in Q1 2021, which was just recently posted, well, it appears as though there's just been so much forward-looking growth along with anticipation already priced into these equities to a point where it has significantly ran up their value over the past year. And now, even with fantastic figures being posted, investor sentiment towards these companies is just not nearly as bullish as it has been previously during the period of March 2020 to around February 2021. Right, so a really clear example is with Amazon stock. I spoke about this in my last video also, but I think it really highlights the point I'm trying to make. So over the past almost 6 months, or at least more than 6 months at this point, the stock has pretty much just been trending sideways ever since its first run up from around March 2020 to July of 2020 also. The returns have pretty much been flat and stagnant if you were to hold that stock over this period of time. However, during this period of time, there has been a massive amount of growth from an actual financial growth standpoint. Revenues have been significantly increasing on a really impressive level, and even just in terms of this company's overall operational growth, Amazon is absolutely crushing it. However, it is still trading at a rich valuation, right? Price to earnings ratio around 62x, which by no means is a cheap stock. However, this is one of these companies that is going to be monumental worldwide in the next 10 years. It already is, but it's only going to solidify its foothold in multiple different industries. However, even with these recent earnings reports, investors don't seem to be nearly as bullish and excited. So the root cause though of large cap American tech stock valuations skyrocketing over the past year really boils down to the interest rates having been so incredibly low, making the cost of borrowing extremely cheap. However, this didn't only limit itself to American tech stocks, stocks, it also rippled over into other industries. It's just that tech over the past year, investors were extremely bullish on it as a result of the pandemic, working from home, and overall just a higher amount of consumption for tech companies in general. Simply put, lowering baseline interest rates pretty much just means that it is cheaper to borrow funds. And so the Federal Reserve had the goal of lowering interest rates to stimulate the economy and then also increase the money supply, pouring that back into the economy with the goal of stimulating the economy over the course of the pandemic. However, what also happened is that a much larger chunk of this money ended up falling into the equity markets. And when interest rates are very low, as we've seen over the past year, overall valuations in the equity markets can swell and expand quite a bit. The reason being that overall returns can pretty much be unlimited above the cost of borrowing. What I mean by this is if it costs you 1% to borrow and you're able to go and generate 3 or 4% on that borrowed cash, well, you are able to make a split there. However, if your cost of borrowing was 7%, it becomes much more difficult to invest that money wisely and make a higher return on your investment. But on the flip side, when interest rates do start to rise, well, it's a completely different story because investors are able to go and get a more stable return, even if it is a little bit lower in something that is more stable than the equity markets or high tech, high growth, right? So what ends up happening is that when interest rates end up going up, well, valuations tend to drop down a little bit to more reasonable levels. So yes, all of the above did greatly contribute to the recent rally that we saw in the tech industry. But if we look at a company like, say, Canadian Pacific Railway, which is a freight railway company, well, their stock chart over the past year actually greatly resembles that of most tech stocks, even though it operates in a completely different industry. My point being that while the trillions of dollars that were printed over the past year did indeed help tech stocks reach such high valuations, the main difference being that there was significantly more euphoria and investor optimism towards the tech industry and some other higher growth, higher speculation plays, which led to the valuations reaching higher levels than ever for many of these companies. And all of this is now combined with the imminent fear of rising interest rates over the next couple of years. I'm sure this isn't news to you if you do watch YouTube videos related to finance. That's pretty much all creators are speaking about over the past couple of weeks, but this is definitely a valid concern in that rising interest rates is one of the limited and only ways really that the Federal Reserve and central banks can counter inflation. What we've been experiencing over the past 2 months or so though is much more of a market rotation out of some of these higher growth and higher expectation industries like the tech industry into a handful of other industries, because many companies, say in the industrial, banking, and let's say alternative lending industries, have hardly seen a blip in their share prices over this same period of time, where industries like high tech along with more speculative plays have been seeing a pretty rocky patch. This happens to also be the case for some other categories of stocks. So even though this video, I did concentrate quite a bit more on large cap American stocks, because over the past year, this really is where most of the money has sort of flowed, leading to these high valuations. Well, again, though, rich valuations aren't necessarily the case for the entire market right now. For example, take a look at these two charts right here that showcase the forward-looking price to earnings of the S&P 400 mid cap and the S&P 600 small caps. By the way, just a refresher here, a small cap stock is going to have a market capitalization between $300 million and $2 billion. And then a medium cap stock is a company that's going to have a market cap ranging between $2 billion and $10 billion. Quite a big difference there. So basically what we're looking at is the average valuation of the 400 mid caps and 600 small caps in America on a forward-looking basis. And although the valuations are on the higher end, this isn't anything that we haven't seen in the past. In fact, the large cap stocks are quite a bit more expensive, where they're still well above historic averages. Now, does that mean though that for some of these larger cap stocks, we're going to see them drop down in valuation back to say 2018 or 2014 levels? Of course, it's impossible for me to say, but I kind of doubt it. To me, there's just no way that we're going to see, say, an Amazon reach back down below, say, say a $2,000 a share level, or even Apple at a $47 a share level. That's just not going to happen. I think that despite the recent earnings, which have been stellar for these companies, by the way, we're seeing much smaller sustained price action. And I'm thinking that we'll continue seeing these companies grow at a tremendous pace from an underlying standpoint, which will in turn allow them to sort of catch back up to their valuations. In fact, again, looking at this table right here, the forward PE estimate for the S&P 500 and the NASDAQ 100 are significantly lower than what we're seeing at the moment, even though I expect underlying financials to increase for most of the companies that are held within these indexes. Now, in terms of some of these either small or medium cap companies that I'm personally invested in, here is one prime example. So CRSR, right? Corsair Gaming, which is a medium cap stock and which hasn't performed very well, to be honest, over the past couple of months, but it now has a forward PE of right around 15.5 and a price to sales ratio of only 1.54. This is not necessarily a stock that I see as being expensive, especially considering its rate of growth, along with the rate of growth of the industry over the next 5 years. And actually, quite a large portion of my overall stock portfolio that is held outside of index funds, which does happen to hold a much larger portion of large cap stocks, is in small and medium cap companies that I see showing tremendous potential for future growth. So moving forward though, well, let's now speak about the potential inflation that seems to be one of the main causes of this more recent stagnation and sell-off. Even though previously the federal government had mentioned that they would most likely be keeping interest rates at a much lower level, well, now under the narrative that consumer prices have jumped by around 4% in the month of April, which is the fastest that we have seen actually since 2008, this has resulted in investors wondering when and how the Fed will respond to this, which, as we just mentioned, is most likely going to be by increasing those underlying interest rates. It's quite interesting though, because if you think of it, well, over the past year, the markets have been pricing in quite a bit of future expected growth, and it's been in a period of bullish movements and lots of moments of euphoria. But now it almost appears to be the opposite, where recent earnings were fantastic, as we spoke about earlier, but it almost appears as if investors are now pricing in these inflationary fears and selling on this news. But in the bigger picture, of course, yes, these types of fears and headlines are going to have an impact on short-term stock trading. This is just commonplace in the world of shorter-term investments, where equity price movements are more tied to shorter-term news than underlying company financials, where on the bigger picture, if you zoom out, you can see that this is extremely commonplace. So if you're looking to hold a stock for 3 to 6 months, let's say, well, of course, these types of shorter market movements are going to have a much larger impact on your potential return. This is something that I want newer investors to really understand. In addition to this, here's a chart highlighting some black swan events and how this is just such a small event in the larger picture. It's easy to get really caught up in things in the short term when you follow things so closely and watch YouTube videos, but life will move on, and most people don't follow the markets as closely as most of us in the investment community do. So my point being here that each one of these new headlines that come out appear to be much larger in relevance and importance to the longer term scale and picture of our investments, but really this is extremely normal. If you look at headlines from every single month over the past years, essentially quite indefinitely, there is always going to be headlines about certain fears, certain things that are going to impact the equity markets, and of course we are going to see larger bumps and hurdles along the way. But on the larger picture, if you look at historically, equity markets tend to move up if these companies do end up increasing their underlying financials, which, as we saw, they are. So again, it's completely normal for markets to go through cycles and for short-term news to affect short-term price points. But with all that said, what exactly am I doing right now? All right, so the first thing is that if you do have an investment strategy like mine where you are looking 5, 10, 15 years out because you are younger and you have a longer time horizon ahead of you for your investments, well, it doesn't ultimately really matter all that much what happens in the shorter term markets. As I was saying earlier on in the video, it's really easy to get caught up in what's happening in the present, right? The now, in the shorter term, month to month, or even week to week movements of the positions that you're holding. But I've been saying this time and time again on my channel that if you're taking a position in a company, you should be doing extensive research, due diligence about the company, their financials, underlying financials, and why really this company fits within your overall portfolio and your goals as an investor. I know sometimes I might sound like a broken record about this, but you shouldn't just jump into an investment for XYZ reason because someone else told you to, or because you just think that it's going to be a quick short-term swing trade or even a gamble. So to that, I would say two things. The first one being that if you do invest like me, you're looking into a longer term hold in position for certain companies, and then you're also doing that extensive proper due diligence on these companies you're investing in, well, shorter term price drops should be seen more as an opportunity. Of course, this can change over time as your investment thesis changes on an individual company or industry, let's say. However, this should be seen as more of an opportunity when the prices see some more volatility so that you can dollar cost average your way into these investments to have a more steady return over time. The second thing is that everything I just mentioned is a lot easier to implement when you're in a bull market. So when the prices are going up, it's really exciting, and dollar cost averaging and at least in your mind sticking to your guns is quite a bit easier than when you do see higher levels of volatility and your positions and your portfolio is losing value. It's at this moment that implementing that strategy and sticking true to what you set out for your portfolio becomes quite a bit more difficult. So yeah, in an environment like right now where we're seeing a lot of diversity in different industries and even different asset classes, real estate, cryptocurrency, stocks, everything right now is at a point where we're seeing higher amounts of volatility. Prices are skyrocketing left and right, and a lot of newer investors seem to be thinking to themselves that by jumping from one investment class or one actual individual position to another, they will get ahead. But in reality, what typically is going to happen for the vast majority of investors is that you're going to enter and exit positions at inopportune times and actually not end up creating a nice return on investment for yourself. So define your goals as an investor, create a plan, dollar cost average, and call it a day. And the last thing I want to add to this video is that when you're doing stock analysis for a new position or even a company maybe that you already hold in your portfolio, there needs to be some backbone to your overall thesis on the company, right? It's okay that you can change your investment thesis for a stock or for an industry if new information is brought to the table that sort of changes the playing field for what you're investing in. But if you're only changing your thesis on a stock, an industry, etc., based exclusively on price action, you should probably be taking a step back and reassessing how you're approaching the market and how you're approaching your own portfolio and your investment strategy. Again, market volatility is completely normal, to be anticipated, and should actually be seen as an opportunity for your longer term plan. So with that said, I really hope you enjoyed today's video. If you did, make sure to smash the like button, it really helps the channel out, and subscribe, hit the bell button to be notified of new and upcoming investment content. We speak about the stock market, real estate market, and a whole bunch of things in between. I would also highly recommend that you check out the links down below to open up either a Wealthsimple trade account. You'll get $25 for free when you open and fund your account with $100, and then also the full 60 video lecture stock market investing course that I have created for individuals who do need more of that structure and overall orientation about how to navigate the stock market and create a portfolio that's suitable for your needs as an investor. So with that said, thanks for watching, and I will see you in the next one.